Hi, it's Raoul. Guess what? I can't believe, but we're turning 10 at Real Vision this September. I can't believe it's a whole decade of democratizing the very best financial intelligence and building this kind of super community of finance, including the super platform of finance. And to celebrate, we're throwing a virtual party on September 27th at 12 p.m. and you are on the guest list. It's free to join, so don't miss out. If you're not a member, you can sign up at realvision.com/free. We've also got a trade ideas competition where you can flex your market smarts, plus some exclusive limited birthday merch and much more planned for September. It's going to be a lot of fun. So sign up realvision.com/free and we'll see you at the party September 27th at 12 p.m. That's realvision.com/free.
Hello out there. Welcome to another edition of Macro Mondays as we look forward to a very, very interesting week in global macro. My name is Mikkel Rosenvold, and as you can probably tell from the setting here, I'm still stuck at the home office. Here in Denmark, we've had a very sudden change from summer to winter conditions, and that apparently caught me with a bit of a sniffle. So I hope you'll excuse my voice for being a little rusty this morning. Andreas, welcome to you as well.
Thanks, Mikkel, and I wish you a speedy recovery.
Yeah, absolutely. You seem to be in better shape ahead of a very, very interesting week, and we're going to cover that, of course. We're going to be looking at the FOMC meeting, the decision ahead for the Fed, how to position for this also for the rest of the year. And then, Andreas, I'm sorry, we have to touch upon gold as well.
Yeah.
So, Andreas, obviously this show is a sneak peek into the research that we do at Steno Research, all the content that we publish at stenoresearch.com. We aim to be using some of our data models a little bit less so this week because we're very focused, obviously, on the FOMC meeting. But you can get access to all our content plus much more at stenoresearch.com. Andreas, perhaps we should start by looking at last week because a couple of interesting things happened as well. Maybe we should start on Tuesday with the presidential debate. I know you watched this as well. Obviously, it's during the night times here in Denmark, so sometimes we're a little bit behind. But I mean, you posted this fact-checking statistic, which is obviously hilarious. That Kamala Harris had one. I mean, technically, it's true that Kamala Harris had 1+ false claims, and Donald Trump had 33+. I mean, 1+ could be more than 33, but I mean, it was the narrative was very much that Kamala Harris won this debate. I think the fact checking has reached an almost absurd level right now. Well, what do you think, Andreas?
So I mean, I watched this presidential debate, and I mean, just based on my own little sort of anecdotal evidence here, I found at least a handful, maybe a couple of handfuls of outright lies from Kamala, probably many more from Donald. And I'm not really trying to stick with either candidate here. My point is just that they're both lying, and it's not really the impression we got from watching this, and also from seeing how ABC handled the moderation of this debate. So I find it intriguing almost to see how the media is portraying this presidential election now. And I think the objective answer and the objective observation here is that both sides are lying. There's probably a clear difference in the substance they're lying about, but they're both lying to some extent at least. And I basically gave up. I tried to count all of this, and I have a life. I mean, so yeah.
I get why they ended up at 33+, but the 1+, that's a little lazy, we have to say.
Yeah.
So there's obviously we need to look at the outcome of this debate on the effects of the presidential race. If we take a look just at the betting averages from Real Clear Politics, nothing happened after the debate. This is very telling, I think. We had a little bit of a bump just before the debate, but essentially, even though the consensus view is that Kamala won the debate very clearly, we saw almost no effect either in the betting averages or in the polling. It seems like both camps are very, very well entrenched. They know who they're going to vote for. If you watch that debate, it's probably because you're politically interested and you know who you're going to vote for. So really, no votes were shifted across the center aisle. So by now, it's more a question of getting people out there to vote. Weather conditions could play a role, and also what I think is the meme factor in this election, because I think the mobilization of especially Democrat voters is going to be based on whether they can create an urgency to get out there and vote among younger, among minority voters. And that could be driven by strong memes, such as the whole Weird campaign. So we shouldn't downplay the importance of memes here. Perhaps could even be more important than this debate, even though it was of course a huge event. We still don't know if there's going to be another debate, a second Harris-Trump debate. We'll see. But anyway, for now, limited effects on markets, I would say.
But I'm still of the view, Mikkel, that we sort of got the impression of two candidates aiming to spend a lot of dollars still, aiming to bring interest rates lower. I think they both agree on that, and aiming at trying to tackle this mountain of debt that they've built up in the U.S. Treasury by having probably a slightly lax approach to inflation relative to interest rates. And we'll get back to the gold trade, but the gold trade liked what it saw. Let me put it like this. And I guess that's one of the main takeaways from this debate, that they both couldn't care less on how to balance the budget.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Absolutely. We'll get more into this as we edge closer towards the election. But for now, Andreas, let's move towards some of the headlines from last week. We had the ECB meeting, your old favorite Lagarde taking the center stage here. Were you surprised at the announcement or the renewed forecasts of the ECB?
Well, the ECB is doing ECB things as per usual. They sound completely out of whack with what we've seen from the Federal Reserve and to some extent the Bank of England and other central banks. They decided to upgrade or lift their projections for inflation while cutting interest rates, which is kind of an odd signal to send. Also, given that everything survey-based, everything market-based on inflation expectations is on the floor, if not through the floor. So it just sounds out of whack to tell the audience that inflation expectations are up, at least in their projections relative to June. So I guess the bottom line here, and also clear reason why the dollar is being sold off heavily against peers here, is that the ECB will be very slow, very responsive to what they see elsewhere. They don't see a major need to cut fast. And at the same time, we're about to discuss whether the Federal Reserve will cut by 50 basis points this week. And if they do so, we'll have diverging paths, basically, for the Fed versus the ECB here. So the ECB, this is typical the ECB. We saw the same thing happening prior to 2008. By the way, you can say the same thing about Bank of Japan being stuck in a discussion on inflation being too high and interest rates having to come up and all that, while all other central banks are stuck in the opposite direction, or in a discussion on the opposite direction. So it's central bank classic. The Federal Reserve will set the pace. Bank of England will follow soon after the Federal Reserve, also if they go 50, while the ECB and Bank of Japan will be stuck in some sort of weird academic discussions with no whatsoever connection to reality.
We'll get more into the FOMC decision here, obviously.
Sorry for ranting, but it's just the same thing every time.
No, I mean, absolutely. We've covered that extensively here. Speaking of no link to reality, Andreas, I really like this headline out of the CPI report.
Yeah.
It's, I mean, once again, it's probably technically true, but what were your main takeaways from the CPI report? We have the decomposition with us as well, if we should dive into that.
So I have two major takeaways from the CPI report from the US last week. First of all, who the fuck cares? I mean, that's the main takeaway. We had a surprise on the upside, and it took like a couple of hours, and then no one cared about it. We had interest rates heading lower again. The dollar sold off and all that on the back of it, which is pretty interesting because, I mean, this is by no mean, if you look at it objectively, it's by no mean a home run. For the Federal Reserve, we still have sticky inflation in a couple of cost categories that they've promised us 18 months in a row will slow. So we're talking about shelter costs, we're talking about public transportation and stuff like that. So I guess if you look at it in isolation, had we seen this kind of report in another point in the cycle, people would have been scared about tighter policies, but now we're just ignoring it. So I guess the short but sweet answer here is that this report did not solidify the view that inflation is going down to 2% on a trend basis, in my opinion. But the other important takeaway is that no one cares. And it will take quarters in a row with inflation surprises to the upside to alter this picture right now. I can stand here and scream about inflation not reaching 2% and maybe accelerating next year and blah, blah, blah. No one cares.
No. Is there some delayed effect, Andreas, to the to the deflation in especially in energy prices here? Will that spill into shelter transportation services in coming prints, or what's your expectation there?
I think that's kind of fair and not really fair anyway. So if you look at energy prices right now, they're obviously on the floor. We've seen a trend towards weaker commodities. That's one of the things we've had very right over the past couple of months and earned a lot of money on, ex-gold. Sorry again, mentioning it.
Come back to that.
But the headline inflation is, of course, more free-floating than the core inflation. And when you look at the cost categories in core inflation that sort of keep inflation high, we're talking about shelter costs, insurance costs, and stuff like that. And they typically work with the time lag. So I agree on sort of the direction of travel. When headline inflation goes down, it takes a while, and then shelter and insurance costs will follow. It has taken a whole lot longer than usual this time. Let me mention that. And on top of that, the issue here is, will cost pressures in these sticky categories dissipate fast enough for them to be fully gone by the time where cyclical prices re-increase? That's the big question, and I'm still skeptical. But it doesn't really matter right now. When at some point oil prices will obviously go up again, right? And the question is whether shelter costs and insurance costs, they're gone by that time, and I have my doubts.
So, Andreas, the reason I brought this along, even though nobody fucking cares, as you mentioned, is obviously that this forms a backdrop to the FOMC meeting this week. The big decision seems to be not whether or not we'll have a cut, but how deep the cut will go. I just want to throw this in here. We like to be a little self-critical sometimes here. This was our conclusion on top of the CPI review we just talked about, that 50 basis points is off, which makes sense basically from the analysis you just laid out, Andreas. But then we had an analysis from the reporter of the Wall Street Journal called Mikkel Rosenvold, who seems to have a lot of connections and probably know a little bit more about what's actually going on within the FOMC. Why are we paying such attention to this?
So his articles have been very neatly forecasting decisions from the Fed earlier. And this is something that has caught the attention of markets over the past couple of years, where Nick has been able to precisely predict what happened at upcoming meetings. So I guess the conclusion is that Nick is very well connected within the committee. And I guess this was around 24 hours after this release of the CPI report. We suddenly got this headline that it was a close call between 25 and 50 basis points. So apparently some of the members of the committee, they lean towards 50, maybe even Powell. And that's interesting in itself after the market, as we did, kind of concluded that it was a 25 basis points meeting after that hot inflation report. the interesting thing here is that it solidifies what I just said. The Federal Reserve could not care less about inflation now. They think it's within the realm of their target, whether it's 2 or 3, it doesn't really matter, because the labor market is weakening, and that is the sole focus of their dual mandate right now, to avoid further weakening in the labor market. So we've seen that major shift of attention, and I actually think it's fair to cut 50 basis points if you solely base it on a labor market analysis and not on an inflation analysis. So that's probably where they're at right now. And I mean, if you put a gun to my head right now, I think they'll go 50, because Powell he's told us that he will not accept any weakness whatsoever from here in the labor market. And the labor market is weaker on all measurable parameters relative to their base case from June. So obviously they can use that as an excuse to move ahead and cut rates quickly. We had the discussion last week, and that's probably the more serious analysis behind what I said on the ECB versus the Fed. It takes a whole lot longer for the labor market to weaken in Europe due to bureaucratic labor unions and very bureaucratic processes around how to lay off people. So I guess that's why the Fed can move faster, and why the Bank of England can move faster than the ECB. We, by the way, got a labor market report from the UK last week, also suggesting that there's a net negative payroll development in the UK. So the labor market is weakening. That's why they can go 50, because no one cares about inflation.
If we look at this choice, Andreas, between 25 or 50, or these two possible outcomes, that if that's our space for those, it seems to me that there are two competing lines of thought as to how markets will react to that, especially equity markets. The one is obviously that a deeper cut means more fuel to the economy, a bigger boost. The other is that a bigger cut means that the Fed is more negative in its analysis of the current economic standing, and so it's a bad news. Which do you subscribe to?
So take a look at what happened around the first cut in other cycles. It's very rare that you see a landslide in markets just around the first cut. And I think this chart is very, very telling. This is the broad US Treasury Total Return Index around the first cut from the Federal Reserve the last 5 cycles. It's essentially a 100% hit ratio strategy to be long US Treasuries around the first cut. So assuming they do 25 on Wednesday, it's less than priced in, so market rates will likely increase. But at the same time, I also consider 25 a warning signal for the equity market, especially since we're entering a very weak liquidity season the last couple of weeks of September. So if they do 25, the equity market will likely sell off and then convince the Fed to do 50 at the next meeting. So that's a strong signal for the fixed income market anyway. If they do 50, they do more than priced in, the fixed income market will do well. I think it's as simple as that right now. There's no reason to complicate matters more than necessary. And in relation to the response from equity markets and other risk assets such as crypto, if you take other cutting cycles as an example of this, you have a few outliers where the economy fell out of bed. But other than that, the average return is very strong after the first cut. So it all depends on whether the economy falls apart or not. And I don't think as of now we have the evidence to say that the economy is falling apart. So the fourth quarter may be very solid given the Federal Reserve moving as aggressively as they are likely to do here.
Very interesting.
And I mean, one thing, Mikkel, I saw you posted the chart just before in the slide deck here on the correlation between equities and fixed income. And I think that's also the ultimate testimony to inflation not being relevant for markets anymore. When you look at the correlation between fixed income and equities right now, it's evident that the good old pattern where you can use fixed income as a hedge against the equity market, that pattern is back. The correlation is again negative after a few years of positive correlation because of high inflation. So if inflation is below 3%, will have that correlation being negative between fixed income and equities, while if inflation is above 3%, that correlation is positive. So it does mean a whole lot to your portfolio construction right now. You can basically use fixed income the way it's intended to work. And that's also why we've flipped more positive on fixed income since mid-July, as you can see from the chart here. And it's one of the few things that that's been working very well for us on a trend basis, outside of being short dollar versus yen. By the way, still a very strong trend, also given what's upcoming in fixed income space.
Very interesting. Andreas, you just touched briefly upon Bitcoin. I just want to go through a couple of other asset classes in this discussion of how to position for this upcoming FOMC decision and the rest of the year. I know this chart is a little bit tricky, but I think it's really interesting. It basically shows positive or negative correlation between the interest rates and Bitcoin. What should we expect from as a result of a cut this week in Bitcoin?
I think it is most likely positive. And what you see here is that the correlation between 1 year forward rates in gray in dollars and Bitcoin is not stable. So either you have a very negative or a very positive correlation, more or less. Currently, we have a very positive correlation, meaning that lower interest rates means lower Bitcoin. But it typically doesn't hold through the whole cutting cycle. And as our head of crypto also notes, it didn't really work out that way during the cutting cycle last time around. So correlations are not stable between risk assets and interest rates, and they're currently turning, which is interesting in itself.
And so, Andreas, I can't keep holding anymore. We have to talk a little bit about gold. Let's start with the future outlook here. We'll get back to reassessing our analyses. This is a chart of the gold price, the development in gold prices after the first FOMC cut of the last 6 major cycles. It seems like some of these cycles had a momentum to gold, especially 07 and 19, but not all of them. What to expect out of gold looking forward for the next 2 to 3 months?
So admittedly, that's one of the few things that we've had very wrong over the past 6-8 weeks here. Thankfully, we've had other things in the portfolio saving us from being completely wrong-footed by this. When you look at the gold price right now, it's running hot relative to what we've seen around other cutting cycles. Maybe because this cutting cycle is priced so aggressively, despite the lack of a major drawdown in the actual economy. If you look at gold flows right now, they're very driven by Westerners, and that's basically what I've underestimated. The gold flows from Asia are not as strong as they were when the dollar was much stronger than it is right now. The reason is that the Chinese and Japanese investors, they used gold as a hedge against a weak local currency. They don't have the same need right now with the dollar being sold off against everything on earth, but including gold. As you can see from the hit ratio of being long gold after the first cut, it's very rare that it sells off. So, I mean, I don't think there's a major downside risk to this. I have to admit that. But it's also not a very strong case on the upside. I think it's safer to be long the treasury bet than to be long the gold bet, given that a lot of these Westerners currently piling into gold, they're only in it for the short term, so it makes it much more vulnerable to volatility.
Andreas, just to circle back on or take another circle on the gold trade, we obviously posted this meme a bunch in this show, which had 3 for 4, correct?
Maybe even 4 out of 5 until recently.
Yeah, you could say that if you include silver, absolutely. So I just wanted to bring this chart before we close off, Andreas, because I think this is very interesting with regards to how we understand the gold price. So this essentially shows that the correlation between gold and real rates basically split off after the Ukraine war. That correlation was dead. Now it's perhaps coming back, as we see towards the end of this chart. Why is it coming back right now, you think, this correlation?
So between 22 and 24, until recently, basically, the gold flows were very driven by what you typically label as the global south, so central banks from Asian countries, African countries, Eastern European countries to some extent, because they essentially saw what the US authorities did to the SWIFT reserves of Russia. And I can guarantee you, as soon as those reserves were seized, we probably had an immediate meeting in Beijing and other of the big global south countries within the central bank committee, asking themselves, okay, how do we hedge against the scenario where the US will seize our assets? And obviously they cannot seize physical gold. So that's essentially why we saw that breakdown. During that time, we had very little flow from like retail and institutional investors in the West, which is kind of interesting in itself. Over the past 2 months, we've had a massive inflow into retail ETFs on gold and also to some extent from institutions in the West. So now the gold flow is driven by Westerners, and I think that's why the real rates to gold connection is back. While it was driven by geopolitics solely over the past couple of years, it's now driven by interest rates again.
Very interesting. So just an attempt to explain some of the dynamics that might also have contributed to us being a little bit wrong-footed here.
Yeah,
we
but
take no shame in admitting that.
Apparently you can just buy gold in any scenario right now. I don't think there's anything that doesn't work.
No. Maybe, Andreas, this is a good time to just play our usual little clip of Gennaro Gattuso. These are our analyses. They're well-founded. We like to explain our thinking, but ultimately this might be...
Sometimes may be good, sometimes may be shit.
Absolutely. So, Andreas, I think that's pretty much all we had for today. Any last points you want to get across to the listeners for the upcoming week?
So we had a very terrible start to September. We flagged that well. The weakness in the dollar scene last week and into the early innings of this week due to expectations of a 50 basis point cut. We didn't get that right. I have to admit that. It seems like the Fed will do 50 now, but dependent on whether they do 25 or 50, the ultimate conclusion changes a little bit, but it does not change in relation to US fixed income. It is the safest bet. If you want something that works now with a higher hit ratio for the near term, it's probably fixed income.
There you go. Thanks a lot for joining us, Andreas. Thanks for keeping up with my rusty voice here. Hopefully we will be a lot better off next week. Thanks a lot, and thanks to all of you for joining. We'll be back next Monday.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.